January 1995, two software engineers sat in adjacent cubicles at a mid-sized tech company in Austin, Texas. Same salary, $42,000 per year. Same age, 27. Same student loan burden, roughly $18,000 each. David Chen decided to automate $100 per month into a basic S&P 500 index fund. He set it up once on a Tuesday afternoon and never looked at it again unless absolutely necessary. He didn't increase it when he got raises, he didn't stop it during downturns, he just let it run. Marcus Webb took his $100 per month differently. He subscribed to 3 financial newsletters at $33 each. Every month he read analysis, he studied charts, he learned about emerging sectors, hot stocks, timing strategies. He felt informed, he felt active, he felt like an investor. By December 2023, 28 years later, David's account held $548,000. Marcus had spent approximately $33,600 on newsletters and subscribe services over the same period. His active trading account, after taxes on short-term gains, fees, and the psychological cost of buying high and selling low during every major correction, held $87,000. Same starting point, same monthly dollar amount, different outcome by $461,000. What happened here was not random, it wasn't luck, it wasn't timing, it wasn't because David was smarter or Marcus was careless. What separated them was something most financial education completely ignores: the understanding that in wealth accumulation, invisibility is an asset. The most powerful wealth-building mechanisms don't feel powerful when they're happening. They feel boring, forgettable, almost embarrassingly simple, and that's precisely why they work. I call it the silent snowball effect. Here's what it means. Wealth compounds most aggressively when 3 conditions are met simultaneously: consistency without emotion, time without interruption, and invisibility without validation. Most people understand compound interest intellectually. They've seen the charts, they know the math. But they don't understand the behavioral architecture that makes it actually happen in a real human life. The silent snowball isn't about returns. It's about designing a system where returns can happen without you. The mechanism operates in 4 distinct phases. Phase 1, the activation phase, months 1 to 24. This is where the system gets built. You're not optimizing for maximum returns here, you're optimizing for automaticity. The goal is simple: create a transfer of money that happens without decision-making. Direct deposit, automatic withdrawal, 0 clicks per month. The number doesn't matter as much as the elimination of choice. Why? Because choice creates friction. Friction creates delay. Delay creates abandonment. David set up his $100 transfer once. It became infrastructure. Marcus made a choice every single month: which newsletter to read, which stock to consider, whether this was the right time to act. Choice fatigue compounded negatively. Phase 2, the invisible accumulation phase, years 2 to 10. This is where most people fail because nothing feels like it's happening. Your balance grows, but slowly. $100 becomes $1,200, then $2,400, then $5,800. These are not life-changing numbers. They don't buy you a car. They don't change your lifestyle. They sit there, quiet and unimpressive. The psychological trap: our brains evolved to notice change, not accumulation. We notice the new phone, the vacation, the restaurant meal. We don't notice the thing that stays still and grows by 8% per year. During this phase, the silent snowball is most vulnerable. It's vulnerable to interruption, to better ideas, to emergencies that feel urgent but aren't. David forgot his account existed for stretches of 5 or 6 years. Marcus checked his positions weekly, which meant he felt every dip, every correction, every moment of doubt. Feeling is the enemy of accumulation. Phase 3, the threshold phase, years 10 to 18. Something shifts here. The math changes. At year 10, David's account held approximately $18,300. His contributions totaled $12,000. The other $6,300 was compound growth. But here's what most people miss. That $6,300 wasn't earned by David. It was earned by the previous money. The snowball started rolling on its own. By year 15, his balance was around $34,000. His contributions, $18,000. Market growth, $16,000. Now the system is earning nearly as much as he is contributing. This is the threshold, the point where the machine starts to outpace the operator. Marcus never reached this phase because he kept resetting. Every market drop he'd pull out to preserve capital, every rally he'd buy back in before it's too late. He was always starting over. The snowball never left his hands long enough to gather momentum. Phase 4, the acceleration phase, years 18 plus. This is where the silent snowball reveals itself. From year 18 to year 28, David's account went from roughly $40,000 to $548,000. That's a gain of over $500,000 in 10 years. His contributions during that same period, $12,000. The system generated $42 for every $1 he put in. Why? Because by year 18, he had built a capital base large enough that market returns, even average ones, produce large absolute numbers. 8% of $300,000 is $24,000. That's 2 years of his contributions, earned in 12 months, automatically. This is not speculation. This is not genius. This is what happens when you let a system run past the point where most people quit. This pattern repeats with machine-like consistency. Take 1929, the market crashed in October. By 1932, the Dow had lost 89% of its value. 2 investors, one stopped contributing during the crash. The other continued their monthly purchase of $50 throughout the entire depression. By 1950, the one who stopped had returns that matched the market recovery, strong but linear. The one who continued, their dollar cost averaging through the bottom meant they bought shares at $41, $38, $30, $22. When the market recovered, those shares became the foundation of exponential growth. Same time frame, different behavioral response, difference in outcome, approximately 340%. In 2000, the dot-com bubble burst. NASDAQ dropped 78% from peak to trough. Investors who paused their 401k contributions until things stabilized missed the entire bottom. Those who continued automating through 2001, 2002, 2003, they bought the NASDAQ at 1,200, at 1,100, at 1,000. When it reached 16,000 in 2024, those shares represented a 15 times return. The ones who stopped and restarted in 2004 bought at 2,000. Still good, but half the foundation. In 2008, the S&P 500 fell 57% from October 2007 to March 2009. Vanguard published internal data. Investors who stopped contributing during the crash and resumed in 2010 underperformed those who automated through the entire period by an average of 23% over the next decade. Same fund, same company, different behavior, different outcome. March 2020, COVID crash. The market fell 34% in 33 days. Fidelity analyzed their account holder data. They found that accounts with automatic contributions outperformed manually managed accounts by an average of 18% in the following 3 years. Why? Because the automatic accounts bought the dip without knowing it was a dip. They bought on March 15th, March 22nd, March 29th. When the market hit bottom on March 23rd, they were there, buying, not because they were brave, but because they had removed the decision entirely. The manual accounts? Most paused, waited for clarity, resumed in July or August. They were right that the market would recover, but they missed the mechanism that turns recovery into wealth, buying when it doesn't feel safe. Right now, in 2024, we're in a specific phase. The S&P 500 is near all-time highs. Interest rates have risen from near zero to over 5%. Inflation has moved from 1.4% to a peak of 9.1% and back down to roughly 3%. Recession predictions circulate monthly. This is the exact environment where the silent snowball separates from the noise. People are asking, is now a good time to start? The data shows this is the wrong question. Between 1926 and 2023, there have been 16 instances where the market was at or near all-time highs at the beginning of a calendar year. In 14 of those instances, investors who started monthly contributions at the peak still outperformed those who waited for a correction over the following 10 years. Why? Because timing is a single-point event. The silent snowball is a continuous process. You're not trying to buy at the bottom. You're trying to remove the concept of bottom from your decision-making entirely. If you want to track whether the silent snowball is operating correctly, watch for these indicators, not in the market, but in your own behavior. Signal 1, contribution. Continuity rate, track this number. How many months in the past 12 did your automated contribution execute without interruption? If the answer is 12, the mechanism is operating. If the answer is 9 or 10, there's friction in the system. If it's below 8, you're in manual mode. Manual mode is the opposite of a silent snowball. Signal 2, account access frequency. How many times per month do you log in to check your balance? Vanguard's research shows an inverse correlation between login frequency and long-term returns. Investors who check their accounts daily underperform those who check quarterly by an average of 1.5% per year over 2 decades. Why? Because every login is an opportunity for emotion to override the system. You see red, you feel fear. You see green, you feel greed. You act. Action interrupts accumulation. Target, fewer than 4 logins per year. Signal 3, behavioral volatility index. This is personal, not market-based. Track your own decision changes. How many times in the past year did you consider stopping, pausing, redirecting, or optimizing your automated investment? If the answer is 0 or 1, you've built infrastructure. If it's 5 or more, you're still treating this like a project instead of a system. Projects end, systems run. Signal 4, external validation requirement. Do you talk about your investment strategy with others? This might sound strange, but the silent snowball operates best in silence. When you explain your system to others, you invite feedback. Feedback creates doubt. Doubt creates modification. Modification breaks continuity. The most successful accumulators statistically are the ones who set it up and forgot the password. Back to David and Marcus. In 2023, both men are now 55 years old. They work at different companies, but they're both thinking about retirement. David looks at his account for the first time in 4 years. He sees $548,000. He doesn't remember exactly how it got there. He remembers setting it up. He remembers ignoring it during 2008. He remembers his wife asking about it once in 2015 and him saying, "It's still running." That's it. That's the whole story of how he built $500,000. Marcus looks at his account and sees $87,000. He remembers everything. Every stock pick, every newsletter prediction, every trade, every moment he thought he was being smart. He worked harder at investing than David ever did. He spent more time, more mental energy, more emotional bandwidth, and he has less. This is the silent snowball in full view. The system that required 0 intelligence, 0 expertise, 0 market timing, and 0 emotional labor outperformed the system that required all of those things by a factor of 6. Here's what most people miss about wealth accumulation. It's not built during the moments you feel smart. It's built during the years you feel nothing. The silent snowball doesn't announce itself. It doesn't give you wins to celebrate on a quarterly basis. It doesn't make you feel like an investor. For most of its existence, it makes you feel like someone who set something up once and forgot about it. And that forgetting, that absence of feeling, that lack of validation, is the entire mechanism. Wealth is not a product of decisions, it's a product of one decision, automated, repeated across decades, protected from improvement. You don't optimize a silent snowball. You don't touch it. You don't check on it. You don't tell people about it. You set the transfer. You remove the visibility. You let time pass. And 28 years later, you look up and realize that the thing you ignored became the thing that mattered most. If this gave you a new framework for understanding accumulation, the only action worth taking is the one that removes all future action. Build the automation, then forget you built it. The snowball doesn't need you to watch it roll, it just needs you to let go.